Hello, and welcome back to our Business Growth series. Today, we're diving into advanced financial strategies that can make a real difference in your business's profitability and long-term success. In this module, we'll be covering profit margin, optimization, how to identify cost-cutting opportunities and improve profitability, strategic financial forecasting, how to predict future financial performance and adjust your strategies based on market trends, exit strategies and succession planning, how to plan for a business sale or transfer and ensure financial security in retirement. By the end of this video, you'll have actionable steps to improve your profit margins, plan for future growth, and set yourself up for a successful exit when the time comes. Let's get started. Let's start with profit margin optimization. One of the best ways to improve your profit margins is to look for opportunities to cut costs without sacrificing the quality of your product or service. Here are some common areas where you can identify cost-cutting opportunities. Streamlining operational costs. Take a close look at your operations to see if there are inefficiencies. Can any tasks be automated? Are there outdated processes that are costing you time and money? Example: a small accounting firm uses manual invoicing processes that take hours each week. By automating invoicing with accounting software like QuickBooks, they save time and reduce labor costs by 15%. Reviewing supplier contracts and negotiating better terms. Negotiate with your suppliers for better pricing or bulk discounts, or consider switching to more cost-effective suppliers. Example: a local cafe renegotiates its coffee bean supplier contract and secures a 10% discount by agreeing to longer-term orders, saving them thousands of dollars annually. Optimizing inventory management. Holding too much inventory can tie up capital and increase storage costs. Adopt a just-in-time inventory system to keep only what you need on hand. Example: a boutique reduces its storage costs by 20% by switching to a just-in-time system, only stocking items based on real-time demand. Energy efficiency. Implementing energy-efficient practices can save on utility bills. Simple changes like upgrading to LED lighting or more efficient HVAC systems can lower your monthly expenses. Example: a retail store reduces its energy bill by 25% after installing energy-efficient lighting throughout the building. Key tip: regularly review your business's expenses to identify areas where you can reduce costs while maintaining quality. Next, let's look at strategies for improving profitability. It's not just about cutting costs, it's also about boosting revenue and maximizing the value of each sale. Raising prices strategically. Consider raising your prices if your product or service offers significant value to your customers. This can often be done without losing customers, especially if you're offering something unique. Example: a fitness studio increases its membership rates by 10% after upgrading its equipment and offering new classes, while still maintaining its loyal customer base. Improving operational efficiency. Look for ways to increase productivity without adding additional costs. This could mean implementing lean management techniques or improving employee training. Example: a restaurant implements a new kitchen workflow, reducing prep times by 15%, allowing them to serve more customers during peak hours. Expanding product or service offerings. Introduce complementary products or services that increase the average transaction size. Example: a photography studio starts offering wedding planning services in addition to photography, boosting their average sale by 25%. Reducing customer acquisition costs. Focus on retaining your existing customers and encouraging them to refer others, which can lower your overall customer acquisition cost, CAC. Example: a SaaS company offers a referral program that rewards current customers with discounts for bringing in new clients, significantly reducing its CAC. Key tip: improving profitability is about finding the right balance between increasing revenue and reducing costs while keeping your customers happy. Now let's move on to strategic financial forecasting. Forecasting helps you predict your business's future financial performance and make informed decisions about where to invest, when to cut back, and how to grow. Revenue and expense projections. Start by estimating your future revenue based on historical data and growth opportunities. Combine this with projections for your expenses, including both fixed and variable costs. Example: A retail business projects a 12% growth in revenue for the next year based on seasonal sales data and planned expansion into online markets. Methods of forecasting. There are two primary methods for forecasting: qualitative and quantitative. Qualitative forecasting relies on expert opinions and market research, while quantitative forecasting uses historical data and statistical models. Example, a new bakery with no historical data uses qualitative forecasting, consulting industry experts, and conducting market research to predict sales trends. Scenario planning. Create multiple scenarios, best case, worst case, and most likely, so that you're prepared for any financial outcome. Example, a software company develops 3 scenarios. In the best case scenario, they achieve 30% revenue growth due to successful product launches. In the worst case scenario, they only achieve 5% growth due to unforeseen market conditions. Key tip: regularly revisit your forecasts as market conditions change and adjust your strategies accordingly. Finally, let's talk about exit strategies and succession planning. At some point, every business owner will face the decision to exit their business, whether through sale, transfer, or retirement. Planning your exit early ensures you maximize value and set yourself up for financial security in the future. Understanding exit strategies. There are several exit strategies you can consider. Outright sale. Sell your business to a third party and walk away with a lump sum. Family succession. Pass the business on to a family member. Merger or acquisition. Merge with or be acquired by another company. Management buyout. Sell the business to your management team. Example, a family-owned bakery plans to transfer ownership to the owner's daughter after training her to take over operations. Valuing your business. Work with a professional appraiser to accurately value your business based on assets, revenue, and growth potential. Example, a marketing agency uses an income-based valuation, factoring in their recurring revenue and projected growth to determine their business value. Key tip: start planning your exit at least 1 to 3 years in advance to ensure a smooth transition.